between our conversations. 1 week it's up, 1 week it's down. We're all over the place here. But we had a positive day yesterday, and the way things are looking, we see the blinking green on the futures right now. So, let's have a little talk about your weekly piece, which you published on Sunday night. Let's dive right in. Let's go from the top down.
For sure. Volatility is a characteristic of bear markets, no question about it. And the interesting thing that we saw last week was, a potential, bullish reversal day, key bullish reversal day last Thursday when the market gapped down 500 points on a, hot CPI number and then rallied back to close 5.1% off the lows. That to me was an important change in the market's character and certainly impressive. But while it probably marked a short-term bottom, I don't think it changes the bigger picture view of the bear market. We had an island reversal pattern intact through yesterday's close. Even with this morning's, up 500 Dow futures, doesn't look like we're going to fill that gap just yet. We may, but at the end of the day, our thinking at this point is that we probably saw a minor bottom. We're going to rally into levels that probably mark 382 retracement of the most recent decline. That comes in around 3,800 and, plus or minus 10 points. And that would be a very clear kind of three-wave ABC corrective pattern to get back on track. And so, our expectation is that the market will continue to trade lower once we get through this minor consolidation of prices, bear market rally, if you will. I think these 5 to 7, maybe 8, even 10% bear market rallies are really inconsequential to the larger degree trend, which we expect will continue much lower from here. Our primary view is that we're at the precipice of a third wave decline. And once we break below last Thursday's lows, which I think were S&P 3491, I think we'll see a dramatic acceleration to the downside. We've got a couple of dates in mind we've been throwing out there for a while, October 25th and November 8th. We'd add to that November 2nd, which is a Fed meeting day. And, we've got a whole slew of earnings announcements in between, everything from Apple to Amazon to Meta to Google and Microsoft kind of fall in between those two outside dates. And, anything can happen in there. But, our view is that this third wave probably will continue lower until we, mark one of those days with a tradable low.
Well, two of those dates sit on our filming dates, so we'll be here live discussing those two Montgomery cycle dates. If I'm not wrong, the 18th, the 25th and the 8th.
That's right.
I have been listening, Jeff. So let's have a little look into your weekly piece this week. You kicked this off with the traditional 60-40 portfolio, and whether bonds are actually offering any form of protection in this market. Now, are they?
It doesn't look like it to us. At the end of the day, I think risk parity strategies such as the 60-40 benchmark portfolio, are looking at the worst performance they've seen in the last century. The 60-40 is down over 30% year to date, and that compares to an average total return of around 9% looking back over the past 100 years. So bonds, at least long duration treasury bonds, which is, or the ag, if you will, is not really playing the safety role in this market. If anything, it's probably just as risky as stocks. And, from our perspective, we see 10-year bond yields moving considerably higher. As you know, we've got a target of 6% looking out the next, 12 to 24 months. And, we're probably going to get there sooner rather than later, the way the Fed has been hiking rates at, a record pace, frankly.
So you've been advocating a slowdown or reversal in earnings growth for several weeks and months now. Is this starting to pan out the way you see?
Yeah, it sure looks like it. We're looking at a chart that FactSet published, just looking at sector revisions, and the street came into the year looking for something north of 10% earnings growth this year and next. If we look back to just the end of the third quarter, those expectations were reduced to about 8% earnings growth. But 2 weeks after the end of the quarter, we've now seen revisions come down to something with a six handle for growth this year. And honestly, I think at the rate of change that we're seeing earnings revised to the downside, we're very likely to get to our -5% year over year earnings growth for calendar 2022 in the weeks ahead, to put it that way. If you removed energy from this, earnings growth this year is down 4% for the 10 sectors in the S&P X energy, basically. We're looking at energy adding dramatically to the picture, and I think energy is such a small component of the S&P 500. It's kind of inconsequential to the overall market. And so, at the end of the day, our expectation is that earnings will come in sub $200 this year when the rubber meets the road. And we've got a full 2 quarters to report yet. So we're just at the precipice of third quarter earnings reporting. I think, maybe a dozen large cap names have reported basically. And we're likely to see a big acceleration in terms of this earnings revisions to the downside as we continue to see earnings unfold.
Right, so we've still definitely got some information to come out that could be feeding into this even further. Jeff, one of these charts that you put up is the equity risk premium. This is a pretty incredible chart to look at over the years. Is the risk premium just not there at this point?
It's for all practical purposes, it's evaporated. And if we take a look at Thursday's price action as being a low. Okay, if let's put us on the opposite side and say that we're bulls and we're saying, hey, the low is in. Well, normally in that circumstance, the equity risk premium would be, orders of magnitude higher than it is today. Looking back over, the data series going back to the mid 1950s, we said since the Eisenhower administration, we haven't seen equity risk premium this low in conjunction with a quote unquote stock market low. Our view is that we haven't seen a stock market low. And that's the reason why the equity risk premium hasn't blown out to levels in the past. The only other time it was down around these levels or lower was 1990. And that was an interesting year. There was a war. The economy, was facing a tightening cycle similarly. So maybe this is an anomaly like we saw in 1990, but I doubt it. I think circumstances are considerably different and valuation parameters are considerably different. And so at the end of the day, I think what we're really looking at here is the fact that the equity risk premium has not yet peaked for the cycle. That's my conclusion.
More to come. That rolls us into having a look at some of the technicals. This title says it all really, but I'll let you lead with this.
Yeah. So, we've been talking about a level of 3,500 for quite some time, many, many months. We identified a classic pattern top formation of the head and shoulders variety. That pattern counted to 3,500 as a measured move target. We hit that target last Thursday with the morning gap down low at 34.91. Okay, that also happened to coincide with the 50% retracement of the advance off the March 2020 lows and the 200 week simple moving average. All three of those levels, combined with a couple other technical trend, classic chart support levels, all kind of coincided around 3,500. So it is not a surprise to us that the market grabbed 3,500 as a level to bounce from, to gain some traction from. And there's no question in our mind that, this is a minor degree bounce at the very best. We're looking at a weekly chart here, and what three conditions that we would note about the weekly close last week. Number one, it was a weekly bearish engulfing candle. Number two, we put in a lower high, a lower low, and a lower close. None of those are bullish considerations. Now, the final thing that I would say is that the decline from the August 16th high has come in 5 waves. And that 5-wave decline is probably the end of intermediate wave 1. And the rally that we're seeing right now could be counted as intermediate wave 2. There's a couple other alts, and we'll go into this in a second. But there's another pattern that's developed over the top of this head and shoulders. And it's a very large degree inverted cup and handle pattern. And you can see it faintly traced over the top of this. And that pattern counts down to about 2,500 on the S&P 500, which is kind of within the range of 2,750, 2,400 that we've been articulating for primary wave 3 down. So we think the setup here continues to be exceptionally bearish. And once we, take out those lows that were put in place last Thursday, we'd expect the market to continue to accelerate to the downside.
Let's have a look at the cycle degree Elliott wave chart here.
Big picture view of the market, and this takes a look at a 13-year advance off the 2009 low. We count that up as cycle degree 5. It's a 5-wave advance at 3 different degrees of trend: primary, intermediate, minor wave degree. They have all terminated at basically the top in January, on January 4th. And by extension, we think that also topped supercycle wave 3. Now, if that's the case, we're in the midst of a supercycle degree corrective waveform, which should come in the form of an A, B, C 3-wave correction at its simplest breakdown. And so the first wave, wave A, is what we're focused on right now. And wave A should be a motive wave, which is 5 waves: 1, 2, 3, 4, 5. And so wave 1 down terminated back in June. That was primary wave 1, and the advance that we saw off the June lows was primary wave 2, which terminated on August 16th. The decline since then has been the earliest subdivisions of primary wave 3, which we expect to carry down to, at a minimum, the 2,750 level, and more likely lower. We've got a lower range to around 2,400, and we think we can get there by, say, Election Day, November 8th. And so somewhere in that framework, we would expect to see a sharp down move, something that, people might refer to in history books as a crash. We would simply call it primary wave 3 of cycle wave A down. Ultimately, we would expect cycle wave A to terminate sometime in the first quarter next year at around S&P 2250 before we see any really meaningful counter trend advance, which we would expect to be a B wave that could retrace, say, 50% of the entire decline from the Jan 22 highs to what we would expect to be S&P 2250 on the downside.
I hate hearing that S&P 2250. Jeff, let's zoom in a little bit and bring it to the short term.
Yeah, short term, we've kind of been monitoring this entire decline at every degree of trend that's discernible here on a daily chart. And so, we're kind of marking them at least minor degree. And so, coming off the January 4th high, we've got 5 waves down into the February low. That's intermediate wave 1. Rally back into the March highs were intermediate wave 2. The decline down into the May lows was intermediate wave 3. Rally back into those kind of early June highs was intermediate wave 4. And the final decline into the June lows was intermediate wave 5, which completed primary wave 1. We then saw an ABC 3-wave counter trend move into the August 16th high. That was primary wave 2. And since then, we've seen 5 waves down. Now, there's a number of ways we can count this final move to the downside. And so it really depends, how things, how the market trades over the next few days. And we're starting to lean toward another alternate than what we've traced. We've traced the most bearish view so far. So we've got a 1, 2, 1, 2, 1, 2, basically a series of 1s and 2s to the downside, which would suggest you'd be looking at an epic collapse unfolding in the not too distant future. I'd like to actually take a look at the alt cases. And if we look at alternate one, based on yesterday's price action, and keep in mind that we published this Sunday night without the benefit of yesterday's price action for consideration or this morning's strong futures. And so looking at those two data points, we think it's most likely that alternate one is the right count. And that is 5 waves down into the October 13th low was probably intermediate wave 1 down of primary wave 3 down. And what we're experiencing since the low on Thursday morning is a 3-wave counter trend advance that should carry to around 3,800 on the S&P, which is in fact the 382 retracement of that decline. And in our opinion, that should mark intermediate wave 2 of primary wave 3 down. And the next move will be an acceleration to the downside. So, we are pretty confident that this should play out in this format, and the decline should be rather forceful, dramatic, and we would expect it to carry considerably lower down into the mid 2000s in the S&P 500.
Jeff, I ask you this every week, but being ever the optimist as I am, what would change your mind? What would be the number again that would change? What level?
Simple. If the market rallied above 43.25, the August 16th high, then the count is incorrect. It doesn't necessarily mean that the bear market's over. It just means something different than what we've mapped out in our Elliott wave count is unfolding, and we'd have to go back to the drawing board and figure that out.
Got it. 43.25. Let's have a look at some of the market internals.
Market internals were absolutely, dismal last week. Frankly, we put in record lows on 2 of the data series, and these don't go back 100 years or anything, but we're looking at net advancing issues. So we look at a 5-week moving average or 5-week moving average of the percentage of net advancing issues in the top frame here, and the breakdown last week actually set a new all-time record low for this data series, which goes back to around about 20 years or so. So that is something to give consideration to. Certainly, it would coincide with an extreme low. So it doesn't surprise us that you get a condition like this with kind of an interim low like we saw last Thursday. Once we see that kind of back off, we can get back to the business of this. But the bottom line is breadth is horrific right now. Momentum, the middle frame, continues to be oversold. We've made a higher low than what we saw back in the June lows, so to speak. And so our thinking at this point is there is something of a positive divergence in this momentum measure, which is consistent, again, with the bounce in the market. But we do not expect this to rally back into overbought territory. In fact, we expect it to remain below the median line at the end of next week. So we'll see how that pans out. And then finally, net advancing volume on the bottom frame. This also posted a new all-time record low in terms of the up-down volume ratio that we look at, a 5-week moving average of that, which got down to 0.18 times. And so while we did get a bit of a divergence to the upside, I think 84% of the volume last week on the S&P 500 was downside volume. So you did, have a pretty strong day on Friday to offset the possibility of that being 90% down week. The upside, or I should say the positive divergence from these prior lows to, a higher low last week, again, is consistent with the bounce. So these are shorter term breadth statistics that, certainly are consistent with an extreme low and a, counter trend advance. Nothing that I would look at as being, I'm using this to identify the bottom of the market. It doesn't show that here.
I'm almost scared to flip over to the investor sentiment slide now. Oh boy.
Yeah. So investor sentiment is pretty low. Okay. It's been very, very bearish. And so we wanted to go back in time a little bit further. Normally we show this as kind of a 5-year slide. We went back 15 years so that we could take a look at how investor sentiment fared back in, the great financial crisis in 2008. And as we can see, it's been a lot worse, right? The name exposure index, which came in actually at around 38%, or I'm sorry, down from 38% last week to 20% this week. That was quite a change, and you don't really get much lower than that in normal environments. However, back in 2008, it got to sub-zero. So professional investors were net short at the bottom in 2008. So it can get worse. If we look at the American Association of Individual Investors, so the AAII retail investor bull bear spread, we are now looking at minus 35.5%. That's not the lowest it's been this year. It's been below 40, I think 44% negative. But if we go all the way back to the 2008 lows, it was down over 50%. And so, these numbers can get significantly worse than they are right now. And so the people that are pointing to these, bearish extremes in investor sentiment as marking a low, I think they're correct in the sense that it's probably consistent with an interim low, a tradable low, a bear market rally, but it's not the low. They can get lower, and they have been lower.
And it looks like the only thing that's on the rise is actually volatility.
Yeah, volatility's pulled back from its recent peak, but it continues to trend above its 21-day moving average and is well above the 24% boiling point that we've identified looking back over the last 5 years or so of VIX data. And, I think the breakout above that minor downtrend off the prior peaks sets up the VIX for a spike into the low 40% area minimum. And I think we'll see that by the end of this month or possibly around Election Day, consistent with our view on prices. I think a volatility spike will emerge as prices break below that 34.91 S&P level.
Let's have a look at some sectors and some interesting comments from Sam Sovell.
Yes, Sam put together this cycle, economic and market cycle rotation model years and years ago, modeling what sectors have had the most consistent performance in varying phases of the economic cycle as well as the market cycle. And so, what we wanted to do is just simply highlight the fact that financials were up positively last month in the face of some pretty negative overall market action. And it was interesting that Jim Cramer tweeted out, financials might be the new leadership. I think that's right on schedule. He called this perfectly. Financials tend to lead as we're in the midst of the early stages of a recession and a bear market. And so, we are just now really in the middle phase of this bear market decline. Not even the middle. We're still in the early innings of the bear market decline. And, we're not even officially in a recession by most people's counts. I would argue that, that's debatable. We certainly could be in a recession. I think Europe's in a recession. And, from the standpoint of the global economy, once the U.S. sees this, sees a final succumbs to this final blow of economic activity to the downside, I think the globe will be in kind of a worldwide recession. And so, my sense is that that's exactly how the playbook is designed to play out, where financials would tend to be leadership along with utilities and real estate in this final phase of the market, which takes perhaps quarters, maybe years to play out.
Jeff, I don't know, was that comment sponsored by Jim Cramer there? You have to disclose it if it was. Let's roll into my favorite part of the show. How do people make some money out of this?
Yeah, so in the vein that financials may be the new leadership, we decided to pull a bank stock, Cullen Frost Bankers, CFR is the symbol. This is a nice mid-tier bank. Stock's been in a nice uptrend for the last 3 years. It's just completing a 9-month base consolidation within that uptrend. And, the stock went out around 145. I think if it can, sustainably break above that 145 level, we get a target to around 175, which is 20% to the upside. Would use a stop loss at 136 to set a 3-to-1 positive risk skew on this trade.
And anything on the short?
Yeah, on the short side, the pool of candidates to choose from is substantially deeper than that on the long side. But we're going to go with MongoDB, symbol MDB. Stock went out around 191 yesterday. This is a very well-developed, large degree classic pattern top formation of the head and shoulders variety. It has already resolved to the downside with a breakout below 250. That breakdown actually targets a price of $50 a share if it resolves completely to the downside within the scale of the top. And that's about 70% return if you're short the stock from here. We would set our stop loss as a risk budget at 225. That sets up a very attractive 4-to-1 positive risk skew.
Got it. It's quite scary, $50 price target. Jeff, as always, I want to thank you for your time and sharing your thoughts from Alpha Insights.
Great to be here, Mehdi, as always.
And thanks to the team at Open Exchange for making this go live and as smooth as possible. Everyone, good luck investing.